what's the answer here? The economy is tied to the housing industry. Interest rates are low, and they've never been lower in 50 years, and savings and loans and banks are advertising low interest rates, but the fact of the matter is nobody can borrow any money, because when you go out, especially to build a new house, and you try to do comps, your $350,000 house comps out at $250,000, and you don't have.
The answer is not that complicated. The people that messed it up in the first place, the Federal Reserve, which is they've always had authority to govern underwriting requirements and instruments. Are you with me? They can determine the requirements that you need to buy a mortgage, and the instruments, the mortgage documents that you sign, and the Office of the Comptroller of the Currency, which governs national banks, and of course the FDIC. Those three organizations really were sloppy at their best. They allowed loans to go through what are actually called liar loans, where you didn't even have to have proof of your income in order to buy a home. And it was scandalous. We tried to stop that going back as far as 2000 with the Fannie Mae and Freddie Mac reform bill. But everybody fought us, including the home builders. Okay? Because they wanted to have customers and the ability to build the homes. And a lot of us took a look at the future and saying, you know, there's going to be something really bad coming. But we couldn't tell exactly what it was going to be, except that you can't sell houses to people who could not afford them in the first place. So what we have now is this: the recovery is underway, but here's the problem. Out of every 10 applications for a residential loan, 9 are turned down. And traditionally, 4 or 5 of the 9 that would be turned down are really people that have good quality credit. It's just that the bank examiners who work for these regulatory agencies are absolutely ballistic. And they said, well, we don't want to see a return of what happened before. Of course, no one does. But these are just very reasonable standards. And so, so now you have people who want to buy homes, especially homes that are in foreclosure or short sale, meaning that the homes are worth less than what the mortgage on it is. And that's interesting because the demand is there to buy these houses, and once the short sale homes get moved out and the foreclosed homes get moved out, you have to get rid of that inventory. And then you'll have the regular market taking place. The other problem is manufacturers. We're talking to one now here in Henry County. Good credit, he's been turned down by 8 banks. He has an order in hand from a responsible company to manufacture. And he needs an operating loan just to buy the raw materials to do that. And the banks are saying, we can't lend to you because the examiners won't let us lend. And so now you got the Fed, the Office of Comptroller of Currency, and the FDIC. You got 3 guys in Washington that could sit down and could cure this. It's that simple. But instead, that's how we get ourselves out of this, just by having them take a look and say, look, we've got to be more responsible in getting the credit out. You can have all the bills you want to infuse capital in the banks. The banks are loaded. Community banks have plenty of money to lend. It's not an issue of lack of money. It's the fact that the examiners are making the banks be so persnickety that the banks are afraid to lend. That's your recovery. Okay?